Adam, it's great to have you on the podcast today. Thanks so much for joining me here.
Thanks for having me, Ari. It's great. I've enjoyed listening to your other podcasts. So honored to be here.
I appreciate that. So I'm very excited today to discuss quite a few topics with you. But I think for today's conversation, we should primarily focus on real world assets and tokenization. As someone who watches the Interaxis YouTube channel, your YouTube channel, I've had the opportunity to learn about bringing real world assets onto the blockchain. So I want that to be the focus of today's conversation. But before we jump into that topic, it'd be great if you could spend a few minutes and just tell us a little bit about yourself.
Okay, I appreciate that. So I'll talk a little bit about getting to the kind of blockchain crypto world. Is probably my third career that I had was in financial services. So I was a financial advisor, started out in insurance, and then I was a certified financial planner, had my own RIA, registered investment advisor, with my partner, Ron, for several years in Texas. And most of our clients were business owners. I went down that proverbial crypto rabbit hole in late 2017, mainly because Ron had been telling me about crypto and Bitcoin. And I was one of those typical financial advisors, honestly, that kind of dismissed it and said, you know, it's a meme, I guess. We didn't even use the word meme at the time. It's, tulip bulbs, whatever you want to call it, right? It was that kind of asset. I was into more, equities and things like that. And I don't know, for some reason, something struck me. And I think it was when Ron finally convinced me to go buy some. And I did. And I opened up Coinbase at the time, and there were three. This is how long ago it was. All you could buy was Bitcoin, ETH, and Litecoin. And I bought some ETH because naively I thought, well, if Bitcoin is already at $5,000 and ETH is only at 200, surely ETH is going to get up to 5,000. I had no idea what it was, but I was like, I'm going to buy the one that's, less right now. And it went up immediately, and I thought, well, I'm the greatest investor of all time. I'm going to be retired next year. I bought some Litecoin after that, and it went up, and I thought, okay, this is a joke. Come on, this is too easy. And then, of course, everything came crashing down. But that's what sent me down this road that said, I need to learn what this is. I need to learn why there are these thousands of different cryptocurrencies. And I went down that rabbit hole, and I learned about blockchain technology, and I learned about obviously how Bitcoin works and ETH. And I was just so interested in it. I started going to conferences, but didn't put it in client portfolios or anything, which was a really good thing, because in 2018, that would have been really bad for me to start putting it in client portfolios. And then in 2019, started getting to speak at some kind of crypto conferences as someone with letters after my name, because I'm a CFP. I think that's really what they wanted. And that became a YouTube channel, which you alluded to, Interaxis, where I could just explain things. It was, you've seen, right? It's not me trying to get people to buy it. It's not, ape into this coin. It's not, you have to buy Bitcoin or else you're stupid or anything like that. It's, let me just explain to you how it works. From the perspective of a financial advisor, that became Interaxis, in which we teach crypto to financial advisors, to CPAs, to bankers, to attorneys. And so that's kind of where we are on the side also, or not on the side, but another thing I'm doing is working for a multifamily office, helping ultra high net worth, but basically ultra high net worth families or investors or those kind of peoples in crypto with their wealth planning, right? With their tax planning, with their estate planning, with their custodial planning, asset protection, privacy, all those things. So on one hand, educating financial advisors, on the other hand, helping those that have attained that wealth in crypto to be able to plan for it, and most importantly, to be able to utilize and enjoy the wealth that they've created. So hope that's enough of a background in terms of where we are.
Yeah, that's perfect. And I'm sure that along the way, you've learned a lot of things, both producing content, but educating, people in real life, not just online, about the space in the industry. I'm actually curious if you could speak a little to how things have changed since you first creating content. I know it's no more than 3 years now, I believe, that you've been creating content on YouTube. So I'm wondering if you could speak to some of the trends in the industry, some things that maybe you thought would come to fruition, but didn't in fact actually come true. And then the things that you did think were going to happen and then did actually happen.
That's actually a really good question. So early on, when I started doing this, there was no real idea of DeFi, right? DeFi summer was 2020. Before that, DeFi was, there was DAI, there was Aave, which I think was called ETHLend at the time. There was Compound a little bit. There were no governance tokens really. We weren't quite sure why tokens existed. There wasn't a real, much of a use case for them other than obviously ETH, Maker, those kinds of things where there was a use case, but there wasn't the idea of governance tokens, right? Again, we haven't had DeFi summer. I really thought security tokens were going to take off in 2019. I thought that was going to be the year of the security tokens. I think I went to like the Security Token Summit or something like that. And we all thought, well, this is the obvious use case, right? People are going to invest in real estate. They're going to issue tokens against it. It just makes sense for blockchain technology. And that didn't happen yet. As we'll talk about soon in this recording, we're starting to get there. I thought that would happen a lot faster. And I'm not quite sure what happened in there. I think, DeFi summer came about largely, I think, because of COVID, largely, I think because all these people had money and time on their hands and the ability to kind of chat with each other like this without leaving their homes. And so they thought, oh, well, let's just trade tokens back and forth. And, that perpetuated DeFi summer. So I didn't see that coming as quickly as it did. What did happen was, especially in DeFi summer, as you've seen, is that you had this huge growth in yield opportunities and people were making 150 and 200% yield. And I think I was always back there going, this is not sustainable. This is not going to keep happening. Eventually yields come all the way back down as more and more people jump in and kind of saw that it was a lot of extreme rehypothecation there, happening there within DeFi. But again, I always thought the use cases for blockchain technology would happen a little bit faster. And I think part of that is honestly because I wanted them to happen faster. I wanted on-chain identity to happen faster. I wanted on-chain medical records and asset records and all those things to happen a lot faster because I thought those are really good use cases. 180% yield on, some token because you minted 10 billion of them is not a really good use case. It's just a whole bunch of people, exchanging money back and forth, exchanging crypto assets back and forth without real usage, without real growth, I guess. So that, I guess if the question is what has happened or what hasn't happened, I didn't expect DeFi to blow up like it did. Certainly didn't expect NFTs to do what they did, especially when they were mainly, digital art. And I can tell an interesting story about that. I don't know if it's interesting. I can tell a story about that. But I expected real world assets and security tokens to happen faster than they have. So I guess I've been kind of backwards. Real quick regarding NFTs and especially digital art is Eric, what is his name? The Snowfro, the founder of Art Blocks. Actually, he and I were having coffee because we lived in the same city. And this is back in 2018. And he was explaining to me Art Blocks and he explained to me on-chain generated art. And I kept going, there's just no way, man. Like, there's no way that's going to happen. There's no way that's going to be anything. And I knew the guy to the point that I could have probably had what at the height of NFT summer was probably worth $100 million worth of NFT art because of the fact that I knew the guy and I could have picked it up for pennies and I just totally just missed it all. And now I look back and kick myself going, man, my life could have been a lot different had I just opened my mind a little bit. And that gets me to this idea of like, okay, even I, being, a little bit more forward in understanding and learning crypto, need to open my mind more into, what's possible and what some of the different trends are going to be. So I apologize. That was a super long answer to your very short question.
No, that's okay. I recall speaking to the managing partner at Gumi Crypto's Capital. And one of the things that he mentioned was if you were to guess, or you were to look at crypto Twitter, for example, what you'll see 90% of the time, this is something he estimated, is just scams and bad projects and NFT pump and dumps, coin pump and dumps. And so this overall perception that the crypto space is this get rich quick scheme, overall, it's not entirely a wrong picture, right? That's the majority of what you're seeing. I mean, not necessarily when it comes to market cap. We obviously know Bitcoin's the exact opposite of that. But right, this space is obviously still has a long way to go. Dogecoin, still one of the top 10 largest cryptocurrencies by market cap. Like, this is just a crazy idea. And I mentioned this prior on the podcast when I was marketing a blockchain club in my university. The percentage of people that were familiar with blockchain as something that was not a get-rich-quick scheme or a scam, I would estimate to be like 1% to 2%. And that was for the computer science students who already were familiar with the technology. So it's this real challenge of trying to take away debunk some of these crazy APYs that people were trying to earn. And obviously, in fact, they were earning 100 to 200%. Very few percentage of people who were trying to, at least, but still a percentage of people did. But yeah, it's nice to see people actually earning legitimate yields now in decentralized finance. People are no longer marketing these crazy APYs. They're marketing a way to diversify your portfolio, earn 3 to 5% by adding liquidity to a Uniswap pool or however, whatever method that is. And I just want to mention on real world assets really quickly that I would almost agree with you, as if I were to put myself 3 or 4 years back in your position. It would make sense that real world assets would be the thing to actually take off more than the DeFi space. Anyways, anything to add on to that?
Well, a few things. Yes, you're right. I mean, a lot of the narratives around crypto are very negative, right? It's very much influencers, and they're not even necessarily very good influencers. It's just whoever can pump and dump, and I'm shocked that we still have those. I mean, I'll be honest. When I first got into crypto, I bought some and I tried trading it a little bit, and I got accidentally involved in some of those pump and dump scams. I didn't know what a pump and dump Telegram channel was. I hardly knew what Telegram was. I'm probably old compared to most of the crypto people, and so I didn't think that was possible. And of course, I got scammed on a few of those, to be honest. And to know that there's very much still quite a bit of that out there. There's a lot of people that are just in DeFi for airdrop hunting, which I think is kind of not what we're supposed to be doing here. I think that's a big negative. And of course, those are the things that get promoted. Obviously, when NFT summer was so big, and then you have scam NFTs and the proliferation of NFTs I don't want to say brought down the Ethereum network, but kind of made it so expensive and so slow that you couldn't use it. In the long term, probably looks like a negative, but it's actually kind of a positive, because it means that we had to bring up L2s. Like, everything I feel like is evolving the way it needs to evolve, right? And for you and I, for those of us listening, for those listening, probably it's happening slower than you'd like, unless of course you're one of the people that made millions of dollars in DeFi summer, and then you're going, this is awesome, right? But it's happening a lot slower than I would like in terms of integrating with a financial system, in terms of real use cases. Again, I would have thought real world assets would have taken off faster than they did. But a lot of the real world assets, as we're talking about, is the need to integrate with a traditional financial system, the need to integrate with assets that people are used to investing in. And that just didn't happen fast enough. And there are good reasons for it. Again, things are evolving the way they're supposed to evolve. And I have the utmost confidence that they're going to evolve the way they need to. And I can say again, because I'm older, I was around for the early days of the internet. I saw how it evolved. I saw how early on it was very much about stock price. No one knew what the internet did. No one knew what it was for. You had a bunch of bad ideas. You had a bunch of good ideas that were just too early, right? Pets.com was just too early. Now you have Chewy that's doing really well, right? So we just didn't know what to use it for yet. We're getting there. We're getting to the point that we're starting to know what to use it for. It's starting to be safer. It's starting to be more ubiquitous, easier to use, all of those things. You have to have all that there in order for trillions of dollars to eventually flow in. And eventually it's just going to be the financial system. There's not going to be a delineation. It's just going to be, this is how the financial system works.
Yeah, I completely agree. And just to speak to some of the mind shift that I would say has been going on more recently, I have 2 friends of mine who are in finance, and conversations about blockchain and cryptocurrencies are now more mainstream, as opposed to something that's purely some speculative asset that you try to make a crazy 5x or 10x on. And even more academically speaking, I'm going to be enrolled very shortly in a course on blockchain technology, and I don't think we would have seen that 5 years ago. So the overall, I would say, transition is one towards where we're seeing this mainstream adoption, one where people are actually learning about it, as opposed to something that's trying to just make a bunch of money very quickly.
Exactly. Again, it's a natural evolution of this technology. We always tend to move forward in technology and not backwards. We tend to move towards what is, more efficient, and eventually, maybe not right now, but eventually this is a more efficient, transparent system. We'll talk about transparency. It's just going to be a better financial system, but we just have to get there. And you're right. The proliferation of blockchain courses, crypto courses, whatever they are at universities and even younger, and for younger generations, it's just going to be natural. The way younger generations, using smartphones is just natural. I can't for the life of me get my mom to figure out how to look at a picture on her phone. But for everyone else, my daughter does it like it's nothing.
I think there's still hope for your mother to learn how to see the photo.
She's getting there. She's getting there.
That's good. Okay, so let's talk about tokenization a little bit now. I want to talk about real world assets because I do believe that in part that the future of what we might see, although it hasn't happened to the degree that it could have in the past few years, I do think that there's some serious potential of real world assets. Project like Centrifuge are doing some really cool work. So I think we should start off by getting you to explain what tokenization is from a high level, and then we can maybe build on top some of the advantages and use cases of it.
Yeah, that would be great. And some people call them real world assets. I've heard others, such as Robert Leshner and such, refer to them as just traditional assets, right? It's just what happens in what we see in the kind of traditional financial system that we are tokenizing or putting on chain. So the idea of tokenizing is just taking an asset or a piece of data, right? It could be it could be my car, it could be an invoice that I'm owed money, it could be $1, anything like that, and putting it onto in this case, more than likely a public blockchain like Ethereum. And you and I will probably talk more about Ethereum than anything else because it's the most ubiquitous in terms of real world assets and DeFi and such. But it is the idea of taking that asset and denoting it on a blockchain via a smart contract such that it can be viewed on that chain. It can be moved around. We know who owns it. We know which wallet owns it. And it's not like we're putting that asset on the chain. We're putting something that represents that asset on chain. So again, it could be my car. So now there's a token or a digital representation of my car on chain such that if you wanted to buy it from me, you send me something of value. It could be, 10,000 USDC or something. I send you the token that represents my car. And now the ideal scenario is the government, everyone knows Ari now owns this car by virtue of the fact that he has that token in his wallet. Okay. So that to me is seems like a relatively basic example, and is something, by the way, that's being done already in the state of California. They've already started tokenizing car title in California, right? And so that's essentially what tokenization is. USDC or US dollar coin, or what PayPal just did, right? That's tokenization of assets. That's taking a dollar bill, they hold on to it and they go, we're going to create a digital representation of that dollar bill such that Adam and Ari can transact using a public blockchain and don't have to go through banks anymore.
Mm-hmm. And I think that, so in addition to this advantage of transferring of ownership, right, that could be unlocked, the blockchain. And again, just to remind our listeners, this wallet is basically what stores password to the access of our cryptocurrencies, or in this case, these currencies that represent these real world assets or physical assets, right? And so we can transfer who owns them. And I want to just mention that there also are a couple other benefits that come as a result of putting them on the blockchain, putting these real world assets on the blockchain, one of which is you can provide them collateral in decentralized finance. So maybe you could speak to how this benefit actually works.
Oh, I think that's a huge benefit, right? Because as we saw with DeFi Summer, which I alluded to, you had this huge rise in quote yields, right? Most of them were not real yields, but it was the idea that I could deposit money, whether it's US dollar coin or DAI or ETH or something, into some sort of protocol or smart contract. Someone else could come borrow that. I get to participate in the interest that's being earned, right? Kind of like I would at a regular bank, except we all know that the bank passes on very little of what they collect in terms of interest to its depositors. So that's where DeFi comes in, right? I can deposit DAI or USDC into a protocol like Aave or Compound. That protocol, that smart contract is going to lend it out to Ari who wants to borrow it. If Ari's paying 6% interest, Adam might get 5%, right? That's kind of how DeFi goes. That was always done with on-chain or crypto native assets, again, like US dollar coin or ETH or DAI or something. When we start doing that with real world assets, again, something like my car, I'm seeing it happen with luxury goods, right? People are doing it with things like Rolexes, where they tokenize the ownership of a Rolex or something, and then can go borrow against it. such that if I say, look, here's my Rolex, it's worth $100,000. I want to borrow $50,000. I'm going to use this token that represents that Rolex as collateral. It's going to get locked in a smart contract such that if I don't keep paying the loan back, then that protocol can take that ownership, can take that token from me, or has that token now, and then owns that watch, right? Owns the rights to that Rolex, or controls the rights to the Rolex. That to me is pretty exciting, because what it does is it opens up more of our assets to be utilized for financial purposes, right? And coming from the perspective of a CFP, of a financial advisor, if I had clients that have that have assets like a business, or have assets like their home, obviously you borrow against your home. That's what a mortgage is, right? A mortgage is, I borrowed money and I'm using my home as collateral. People who have businesses will often borrow against their equipment, or even borrow against the future cash flows of their business, or something like that. And they generally have to go to banks to do that. But now what you're going to see as a financial advisor, this is exciting again. If someone has artwork, or if someone has a baseball card collection or something like that, well, now it's an asset we can use more in planning. If they say, look, I want to go, I want to go on a vacation, and they come to me as a financial advisor, I might go, oh, well, let's figure out the most efficient way to get that money. Is it going to be sell some of your stock? Is it going to be sell some of your crypto? Is it money you just have sitting in the bank? Or, by the way, the value of your artwork has gone up. Let's see if we can borrow against that. And maybe that's how you go on vacation, right? It just opens up more opportunities to participate. So it opens up opportunities for me to participate if I'm the one who has the assets. It opens up more opportunities for people in the world to participate, because they can lend the assets. They can deposit and be able to earn income in a way that they never have before. It was always the purview of the banks and the large companies that kind of operated like banks, the shadow banking system, or the pseudo banking system, that was able to participate in those markets of holding money and then lending it out to those who needed it. And now what we're seeing is these protocols are doing that, such that again, I can, with tokenization of real assets, I can potentially participate in the DeFi system without having to have a whole bunch of ETH, or without having to have a whole bunch of Bitcoin or something. I can participate based on the assets that I already have, because I can theoretically tokenize those and use those as collateral. And it's important to note also, Ari, that we're not talking about this in a degen kind of sense. This isn't like I'm going to take my Picasso and borrow against it so that I can go, ape into some coin, or, borrow, buy more ETH and stake ETH or whatever. This is for real use cases. Again, my kids going to college or something like that. If you have more options for where you're going to get your money, you can be more efficient with your finances, right? The more options you have, the more efficient you can be with your finances. And that's why something like tokenization of assets is exciting to me. It adds to efficiency. It adds to options that I have with my money.
And when you tell other financial advisors about the tokenization and its benefits, or even maybe sort of your clients, I'm wondering if there's any pushback that you receive on this point, and if there's any ways that you maybe address these claims, or maybe other perhaps ways to tokenize things that doesn't rely on a blockchain. I'm not sure if there's competitors outside of the quote Web3 space that facilitates the same ownership.
So getting financial advisors, honestly, to get to this point is not that easy, because we have to start with understanding the technology. You got to understand Bitcoin, and then you have to understand Ethereum and smart contracts, and other smart contract chains. And then you have to understand decentralized finance, and what custody looks like, and what collateralization looks like, and all those things, to be able to get to this point of, I can tokenize a building. I can tokenize interest in a private investment. Now we're seeing people tokenizing U.S. treasuries, right? Which seems like the furthest thing. Years ago, that was the furthest thing from our minds, of tokenizing U.S. government debt. And it's the hottest thing going right now in DeFi. So getting to that point is difficult, because, as we talked about earlier, the narrative has been very negative. The narrative has been very degen. It's been very tulip bulb mania, that kind of thing, and not really understanding the value. Once you get to understanding the technology, the custody, the wallets, the smart contracts, and how all that works, then it becomes kind of a natural, and I get financial advisors and accountants and such that take courses from me eventually, when we start talking about, wallets and custody, they start going, can I create a token for real estate? And that's when the light bulb moment is. Yes, you can. Here's how that works. And here's how that's going to be so exciting once that happens. And by the way, financial advisors, accountants, whomever, this is how so many more assets are going to be denoted later, and it's going to be on chain, and it's going to be very native, right? It's just going to be. We've heard Larry Fink talk about it with regard to BlackRock, right? Largest asset manager in the world has talked about how tokenization is going to make his company and the financial system so much more efficient. We've had so many reports lately. Real world assets are the hottest things in terms of banks, financial companies, consulting companies doing all sorts of reports lately. And so this tokenization of assets is going to be so ubiquitous that in 10 years, it's just going to be. You're not going to think, oh, we're tokenizing this asset. It's just going to be, this is how we denote ownership of it. So getting to, again, talking to financial advisors about it, it's getting through that technology understanding so that they know when I talk about tokenizing your home or tokenizing your car or tokenizing a Rolex or investment in a private company, it's not to be a degen. It's not to borrow against it to go gamble on crypto. It's borrowing against it for real purposes. It's tokenizing it and maybe utilizing within a decentralized finance system, because if I own a private business, it's not that easy for me to get a loan that I might want or need for my business just based on the merits of the business. So what can I do? I can tokenize the private equity. I can tokenize my manufacturing equipment. I can tokenize what I want to, such that the bank or whoever lends me the money, ideally some DeFi protocol lends me the money, but then there is some way for that protocol to be able to take that ownership of that asset, right? So it opens that up. And again, it's getting past that narrative that we've seen, that degen or gambling narrative, to go, when I tokenize assets, I'm not talking about cryptocurrency as you know it. I'm talking about utilizing a more efficient, transparent, worldwide decentralized database to just track the assets. Isn't that better than the way we have it now? And eventually they get to that. And I have to go back honestly to things like, remember how Facebook sold all your data? Remember how Google sells your data and Amazon sells your data and they use it against you? Imagine if they couldn't do that. Like, imagine if the data was kind of public, but you had much more control over that. Isn't that what you've wanted for years? That's exactly what we're talking about. It just so happens in this case, the data is the ownership of your car.
One of the things that I come to the conclusion after having these podcasts is that I need to start learning how to program in Solidity, because the code that relies, or the code that the blockchain runs on, different programming languages are used depending on the blockchain. But basically, from my perspective, blockchain and cryptocurrencies, people typically think about it from a finance perspective, and that's true. It is heavily rooted in finance, but it's also a computer science innovation. Blockchain is typically a course taught in computer science. In order to interact with the blockchain, you need to know how to code, called Solidity. And so one of the things that I always feel motivated to do is to learn how to program and interact with these blockchains, because I think that as time goes on, we're going to a direction where the computer scientists, the data scientists, the software engineers, these are the people who are really leading the future of technology, right? I think this is pretty evidently true. And so far on the podcast, the majority of the co-founders that I speak to have backgrounds in software engineering, backgrounds in computer science. And so I think a lot of people forget that, or are not really knowledgeable on that point, that it's really a computer science thing. And I'm obviously very optimistic about computer science, hence my, my drive to learn how to program in Solidity.
I think that's a good idea. I mean, I tell my nephews that are, that are going into college, learn how to program and learn how to program Solidity. They already know JavaScript. I said, learn Solidity and you're going to have a job for the next 20 some years, guaranteed, right? You can do other stuff, but you'll always have that to fall back on if you go learn it now.
Yeah. Okay. So let's talk about factoring a little bit. I know you have a video dedicated towards factoring. So I'm wondering if you could explain what factoring is, and then potentially how blockchain can be used to remove that intermediary to make it a more effective process.
Sure. Invoice factoring has been around for a really long time. And as I've said, it's usually been the purview of banks or kind of pseudo, financial companies that kind of operate like banks. And so what factoring is basically a company like, let's say I sell you some product, I sell you $1 million worth of some product, and I tell you, or you can pay me in 60 days. Our terms are 60 days. Well, I have to pay my suppliers, my employees, everything like that. I can't necessarily wait 60 days for you to pay me, because you know very well, Ari, you're going to wait till day 59 to go ahead and pay me, likely, which is perfectly within your rights. But what I'm going to do is likely go to some other company, a factoring company, and that might be a bank, and go, look, Ari owes me $1 million. Here's his credit. He's good for it. He's always paid me. I could use the money today because I need to pay everyone else. I will basically sell them the invoice, the $1 million invoice, and they might give me $950,000, right? And they know they're going to collect that million within 60 days from you. And now it's their job to collect from you, right? So that's essentially what invoice factoring is. We see it very often in manufacturing. We see it even more so in industries like shipping, right? Because of the number of times that goods are actually good, the ownership or the title of goods actually changes hands in transit. If in that case where you owe me $1 million and I put those goods on a truck or a boat or a train or something, they change hands over and over again. And along the way, the trucking company or the shipping company or the logistics company has to get paid, because they have to pay their drivers. They have to pay all the people working for them. So there is so much invoice factoring going on within shipping and within logistics. But it's always been done through relatively few companies, considering what a monster market it is. Because again, those companies have to pay their people and they want to get paid immediately. If I'm driving the truck, I want to get paid right now. I don't want to wait 60 days to get paid because your company had to wait 60 days to get paid. So factoring ends up being more of a cash flow issue. How can I utilize the invoices that I have, the money that I'm owed, to be able to affect positive cash flow and not have to go into some other kind of debt, not have to go borrow, not necessarily not have to go borrow using credit cards or something, or not having angry drivers or angry employees or angry vendors or something. I want to go take the asset that I have. In that case, it's the fact it's an account receivable, right? You owe me $1 million. Why wouldn't I use that to go pay all my other bills? And if I have to give up a couple percent to do that, I'm okay with it, because it was worth it to me to keep everybody in my chain happy, to keep my cash flowing, to not have to go borrow on a credit card at 13 or 14%. I can go, borrow against what you owe me. That is essentially what factoring is. So I'll stop there and see if there are any questions. But you could probably pull up the data faster than I can. But the amount of money that is exchanged hands in factoring is monstrous.
Mm-hmm. Yeah, thanks for that explanation of invoice factoring. Yeah, when I first listened to this video, I like, oh wow, there's some serious potential there, and I think that your explanation laying that out, it's very clear. I want to jump into a different topic. I want to talk about transparency. Transparency is a term that's used frequently in the crypto space and blockchain space. Now, firstly, I'll get you to explain what transparency means to you in the context of blockchain, Web3, crypto, and I'll share some of my own thoughts on transparency, because I think it's an important point that should be fleshed out a little bit more than it typically is. So I'll get you to explain when you hear transparency in crypto, what do you normally think?
Well, first, I think the idea, my mind of, being, understanding crypto for several years, my mind immediately goes to something like Etherscan. The fact that I can look at every single transaction all the time. And if I send you some bit of crypto, and we'll go back to what it means in crypto, and then we can go to what it will mean for something like real world assets, even invoice factoring, is number one, if I send you something of value, and we'll call it USDC. If I send you USDC and you go, well, I didn't get it or something like that, I can immediately go to Etherscan and go, look, you did. I can tell you exactly when you received it. I can tell you how much I paid for it. I can tell you how long the transaction took. And I can even go further down and go, look, this is everything else that transacted on that same block at the same time as my sending you something of value, my sending you USDC. So Ari, don't tell me you didn't get it. I know for a fact you got it and I can prove it. You take that and extrapolate it further. And you go, okay, I know when I exchanged an NFT with you. I know when I sold you my car, the title to my car that's been tokenized. I can show that, and I can go backwards and prove every hop my car has made in terms of ownership. right? You look at something in the US here like Carfax that goes and tracks ownership of a car and everything that's happened. That's the kind of transparency we have on chain. You look at title to my home. I can go see theoretically every single person who's ever owned that asset on chain instant. That to me is a great deal of transparency. If we want to move forward in terms of extrapolating how important the transparency is, let's go look at the horrible events after the Terra Luna collapse, what happened with Celsius and Voyager, and the fact that we could see in real time what was happening to the vaults or the positions, the lending position or the borrowing positions, I guess, that Celsius had. We knew which were their wallets. We knew what their positions were. And everyone can see in real time when they were getting dangerously close to being liquidated, right? That to me, the transparency there was tremendous because it wasn't a shock to us when they went and paid back those loans, right? They didn't pay back a whole lot of stuff, but they paid back those loans. Why? Because we could all see it. Because we all knew when they were going to get liquidated, and they knew that everyone was coming for them, and people were going to try to, drive prices to a certain level to try to liquidate Celsius, right? That level of transparency is important. In that case, it was for, relatively negative reasons, but what it does is it keeps a very efficient market, right? An example is on the day we're recording this, we had earnings, big earnings yesterday from the likes of NVIDIA, right? Publicly traded company. We don't have to wait for earnings season. We don't have to wait for every quarter for companies to announce their earnings if you have transparency. We know every second what their earnings are, right? We know what's in their treasury. We can look at a Dow and see what's in their treasury. This is why I think transparency is really important, because it almost, I don't want to say totally eliminates, but it eliminates some of the needs of like registering with the SEC. Why do you have to register an asset with the SEC, an investment with the SEC? Because they want to make sure that you're making your books transparent. Well, the whole point of a blockchain is it's already there. The transparency is already there. Everyone can already see it. And that will eventually translate into the, quote, real world assets and all the data that is attached to those assets. So it's not just the fact that I own part of an investment in a real estate building or something. It can be all the data that goes into it. So I can see via this transparency what the occupancy is of that building, what the rents that's coming in. I can look and see all the income that particular token that represents that building has generated. And therefore I get to determine for myself what I think the value of that token is. And therefore I decide, do I want to buy it or not? Do I want to hold it in my portfolio or not? Do I want to lend to that company based with that token as collateral or not? That to me is where the transparency is going to be so important. At this point, I would love to hear what your thoughts are, because you said you have some that maybe hasn't come up as much. So this is where I want to stop and hear what your thoughts are.
Yeah, so I think on the point of transparency, one of the things, so Etherscan, just to reiterate here, Etherscan is a tool that you can look at, basically queries the blockchain, and it shows, let's say for a person's address, which you can think about like an email address, but instead of sending and receiving emails, you send and receive cryptocurrencies. So you can basically just copy and paste this address, and it shows all the money that it entered and exited. Now, currently, right, if you look at these transactions, it's a log of transactions. It's not very clear what's actually happening in practice, right? It's not clear for someone who, for example, who just for the first time sent a transaction to be able to indicate, okay, what exactly happened. It's a little bit of a stressful task for lots of people. And so one of the things that I've also found is that basically when it comes to transparency, we're not quite there yet. And I'll explain why I have this view. So currently, transparency in the blockchain space is only transparent if you know who owns the address, right? So for example, if I'm sending you $5 worth of Ethereum, right? It's only transparent if I make my address obvious and I prove it's my address. And the same is true with you. If you prove that that address is yours and you can receive that Ethereum. Now, one of the things that I found time and time again when researching projects is you have lists of initial investors in projects, you have founders of projects. We don't really know whose address is whose. We don't really know whether the investors are selling their tokens or not. We don't know which founder actually is selling their token or holding on to it for the long term. And so I think the transparency we currently see in the space, yes, it's there. We can read the smart contracts. Our auditing firms are looking through the code to make sure there's no bugs in it to prevent people from stealing money. but it's really far from perfect. I mean, just recently, there was a hack for decentralized finance protocol that resulted in tens of millions of dollars lost. We know that in the case of many of these crypto projects, we don't know whose address belongs to who. We don't know what's actually happening in terms of where these funds are going to. It's very hard to track at the moment. And I'm sure that this is a problem that certain projects and teams are already working at solving.
Oh, yeah, I completely agree. And there's a happy medium to be had between transparency and privacy, right? I don't want everybody to know what I have. And if I go back to the work I do with Bespoke Group, which is the kind of multifamily office where we're helping these ultra high net worth, these crypto OGs or even protocol founders, some of the issue they have is the level of transparency, right? Is like people kind of know which wallets are theirs. And if they go start selling tokens, then everybody's going to know about it, right? And so they, part of what we try to help them with is how do we diversify? How do we, gain some more privacy when the whole point, or not the whole point, but one of the points of this blockchain technology that we have is that level of transparency. And so there is a happy medium that needs to be had there. But you're right. If I don't know your address and you haven't, bought, your own, name, .eth name or something, then yeah, I don't know that that's your wallet to go look at it. But there is also a tremendous amount of research that's being done. So you can go on Twitter or wherever, and you'll see people that are analyzing these wallets that have a tremendous amount of transactions or a tremendous amount of crypto in them and trying to figure out who they are. And they can, go back and probably piecemeal together and figure out who a lot of these wallets are. And a decent example of this is, you've seen probably in the last few days, again, as we're recording this, that all of a sudden there was a wallet that had that had added, I think, $3 billion worth of Bitcoin to it. And it was like the third biggest Bitcoin wallet in the world now. And everyone was speculating on who it was. We weren't sure who it was because there was no name attached to it, right? It's a series of letters and numbers. And everyone said, is this BlackRock? Is this some market maker? Who is this? And it turns out it was Robinhood. It was, Robinhood's wallet. But for days we didn't know. And so there's a tremendous amount of speculation around who it is. And once you find out, then there is quite a bit of analysis that can happen, right? What's happening in the Robinhood wallet? We all look at what happens in the Satoshi wallet in terms of Bitcoin. We look at, we kind of know what happens in DAO wallets, right? We know which wallets are the DAO wallets because they kind of have to tell us, right? We kind of have to know which smart contracts are theirs, which wallets are theirs. So there is a happy medium to be had also between the level of transparency and the level of privacy. I'll say also, going to transparency, it's opening up new avenues of analysis, of analysis of value, of analysis of what happens, I guess, in some of these DAOs and some of these projects, and trying to determine what they should be worth, or the health of the DAO, or the health of the treasury, or the health of some assets. So there's all sorts of new analysis being built. I'll go to Bitcoin on, if a certain number of wallets are in profit with the Bitcoin they've purchased, here's what tends to happen to the price of Bitcoin. Or if a certain number of wallets are not in profit, here's what happens. But we don't have that level of analysis and detail on any traditional assets, right? You can't say, well, here's how many bank accounts, here's how many investment accounts are in profit in NVIDIA stock. You don't really have that level of detail, at least available to the public. But in crypto, you have that. Now we have to infer what the data means. We have to infer the analysis for now, because all we can do is go, well, the last time we were at this level, here's what happened. And here's what we think will happen. And logically, here's what might happen. If most, Bitcoin wallets are in profit, logically we go, okay, well, there's going to be more selling. If the price moves down a little bit, maybe there's more selling because people are going to say, I'm going to take my profit. But that's just logically thinking through what might happen. It doesn't mean that's what will happen, right? So the transparency is giving us a tremendous amount more ability to analyze. We're just not 100% sure what that analysis means at this moment.
Yeah, I personally do enjoy trying to find an address and learn a little bit about the transaction, what that person's doing. If I have my friend's address, seeing, whose funds they're receiving and sending to. And so, yeah, on the point of privacy, one of the trade-offs when using a blockchain is if a person knows the email address which belongs to you, well, they can go ahead and look at your finances. And most people, almost everyone would not want their finances to be public, right? And that's the point that you're making. You want to make sure that you have that nice in-between of privacy, but also take advantage of the openness and transparency of blockchain. It's going to be interesting, I think, the next few years to see how this transparency and privacy point kind of go. I want to move on to just a little bit of a different topic now. I want to talk about Bitcoin versus the Ethereum network, Polygon, Solana, and so on, because, having read Bitcoin Standard, mastering Bitcoin as well as mastering Ethereum, one of the things that I can't say with utter confidence, right, is that Ethereum and other blockchains will be around 100 years from now. I would be more confident to say that based on the history of Bitcoin and how the blockchain operates, Bitcoin will be here 100 years from now. So I'm wondering, really, what made you decide that other blockchains, decentralized finance is something that's here to stay, as opposed to somewhat of something that's less permanent?
One, again, I think I've been around long enough and been through markets enough to know that this is a natural evolution of technology, right? The same way, the internet is still around and smartphones are around. So that's a part of it. Like, I don't have to go deep into how hashing works and how smart contracts work and such to go, okay, this is just kind of how we go with it. This is a natural evolution, right? We went from everyone having their own server to cloud-based computing and cloud service to this is the next thing, right? We don't have to have Google hold all our information. I can, the blockchain, the public blockchain can hold it, and I get to control it based on a wallet. That just kind of makes sense to me as far as a natural evolution. I don't know if I would argue. I would question whether anything is going to be around in 100 years. Just because I think there'll be the next thing and the next thing and the next thing, right? There'll be the next evolution. We could have, at some point we'd have quantum computing, and then what happens to Bitcoin? We could have a next evolution of technology, and I don't know how long that's going to take. In terms of why there isn't only Bitcoin, because I feel that we move fast enough now, especially based on the internet, that we can't handle waiting around, I don't think, for us to figure out how to put assets onto the Bitcoin blockchain. I think the development moves too slowly. It hasn't developed smart contracts, and it's not meant to. It's okay for it not to be everything. It's okay for Bitcoin to be the digital gold. It's okay for it to not have to store the token that represents my car on the same network. It's perfectly acceptable. Just like if you're looking at it from an investment perspective, it's perfectly acceptable for you to have gold and Microsoft stock in your portfolio. It's okay. It doesn't have to be one or the other. They both can coexist for their own reasons. So based on my understanding, and I'm not a technologist by any way, I'm not a computer programmer, I'm not a computer scientist or anything like that. I'm a finance guy. But it seemed like everything that was happening on the Bitcoin blockchain is that they're not meant to progress to the level yet of holding my assets on chain, of decentralized finance at the speed at which we need it to happen, right? And the speed at which we need it to happen is I need to be able to transact more quickly with someone elsewhere around the world. I need to be able to transact, to have more assets be held. I need more opportunities and more choices and more options. And yes, sometimes that means we hurry up and break things, and people get scammed, and there are rug pulls, and then there are just completely, honest people try to create a protocol and they got exploited because they, didn't write their code correctly or something. There are all those negatives to it. But to go back to your question of why do I think there need to be these other chains, these essentially smart contract chains, is because that's a natural evolution as well, right? Bitcoin was an experiment, and the experiment was successful. We could get random people all over the world to connect their computers to a network that not to a centralized server, but basically connect their computers to each other and agree to process transactions according to a code. And the only incentive we had to give them was something we completely made up out of thin air, and they did it. And that thing we made up out of thin air has enough value that more people do it, more people do it, more people do it. The more people do it, it makes the network even safer. The natural evolution of that is, let's see if we can do it with more stuff and faster. And instead of going the direction of Bitcoin Cash or Litecoin or something, we went the direction of, let's see if we can not only move, financial assets back and forth, but let's see if we can move data back and forth. So it's, can I store data in this global database And the only reason that the global database keeps moving forward is we make up something of value totally out of thin air, and we give people the incentive to keep the process moving forward. The experiment keeps working and keeps working and keeps working. And I'm a big fan of evolution. I'm pretty sure that it always works. And I know that because you and I are sitting here on a Zoom call where you're on another continent. And 10, 15 years ago, this was science fiction. And you and I have been doing this for, 4 or 5 years, like it's nothing, partially because of COVID and partially because the tech is just there. So why do I think those other chains work, at least on some level, is because it's just a natural evolution. We want to be able to more easily track our assets. Bitcoin gave us a little taste of the fact that we can do that without having to ask a bank's permission or a government's permission. Ethereum gave us an even bigger taste. And now what we're seeing with either layer 2s or other L1s like Avalanche or Solana, or even, you mentioned Polygon, on top of Ethereum, where we're seeing that go is we have this thirst and desire to be able to transact either financially or move our data or store our data, quickly all over the world, anytime we want, without having to ask anyone's permission. And so people are just going to develop the solutions for that. They're going to keep developing and developing and developing. And we're going to keep trying to consume and consume and consume. And the more we consume and the more assets we get on chain, the more applications there are going to be to utilize those assets on chain.
Yeah, I agree. I think it's interesting. I think that the trend of projects, every project or most projects having a cryptocurrency associated with them is, I think in the next 20 years, will be a dying trend. I think overall, Ethereum and Bitcoin are a little bit different. But like projects that try to solve a problem, I'm not sure that having a token associated with it actually makes a whole lot of sense. And I think we're seeing it past few years, projects diverge away from this trend. And I think also it puts a little bit of a different perspective on what should be about the crypto and blockchain space, because you can build really good protocols and services that doesn't have a token. So Morpho protocol is I had co-founder Paul Frambeau on the podcast recently. And what Morpho does is it lets people earn a little bit more interest when they borrow and lend cryptocurrencies. And how that basically works is it turns a pool-to-peer design into a peer-to-peer design. So it makes it more efficient, bringing people together through math and statistics, basically. And their token's actually not available on an exchange yet. And they've done over 1 billion in trading volume through the protocol, which connects to other decentralized financial services. And that was like wow, that shook me. It had such an excellent use case that it succeeded to such a degree of billions in transaction volume without even having a token associated. But that's the type of thing that I think we're really going to see.
Right. And there's a lot of experimentation there, right? Remember, everyone launching their protocol or with a token, especially in the DeFi space, was based on the DeFi summer. And it was when Compound launched their token. And it was a success, but all of a sudden, anyone who had Compound tokens was able to achieve some sort of liquidity for that, right? They could go sell them on Coinbase or something, and all of a sudden, I earned Compound tokens by virtue of the fact that I had been participating in the network for a while, and then now I can go sell those. I have real money that I can use in my real life, because most of us still don't operate on crypto. We still operate on dollars or euros or whatever it might be. That set forth this, like, everyone had a project. Everyone was going to release their own token. And by the way, all those projects need money to be able to build, to hire Solidity programmers and whomever. And for that money, they need to go get venture capital. And the venture capitalists, of course, want an exit. We can go, get into that talk. But that was a reason why every project had to have a token, because those that were funding it had to have some way to exit. They'd have some liquidity, right? There wasn't, an initial public offering. So launching a token, having it available on at least a DEX or a decentralized exchange, was that exit liquidity for, a year or so for those venture capitalists. But now what we're seeing is people going, well, I don't really know what the value of that project is anymore. I don't know how to value a governance token that doesn't participate in the profit or the revenue or something. And so any projects that do launch a token are going to have really, really good token economics. You're really going to figure out what the value is and why they need a token. And I think you're right. I think we're going that way, to where any project that launches has to, again, just like we talked about with privacy and transparency, there has to be this happy medium between, we need to be able to raise enough money to hire the right people to launch our project to be able to get money in the door, to be able to build a moat so we don't, so someone doesn't just swipe our code and go build the same thing. We need all that. We need to give incentive to people to invest in us, but now we need to do it without having a token that actually has no value. So how do we create that value? And I think there's going to be a lot of experimentation in that regard too, right? Just like there was experimentation with DeFi and NFTs and everything else, there's going to be some experimentation. There's going to be some monster failures along the way. And that's just part of it. That doesn't mean that crypto's bad. That doesn't go to the negative narrative. It just goes to experimentation. The difference between now and the experimentation we saw with the internet in the early days is, in the early days of the internet, we didn't have the internet. Like, we didn't have Twitter and social media and Instagram and TikTok and everything for everyone and their mother to be an expert and call out all the bad stuff, right? So now we have that, and everyone knows about every hack and exploit negative thing that happens immediately, and it gets called out so much more. But the same experimentation was going on with the early days of the internet. It's just not everyone knew about it because not everyone was connected to the internet. You didn't have smartphones yet or anything like that. So there was all this bad experimentation. There were millions and billions of dollars lost on internet companies, but it wasn't as obvious to everybody because most people didn't know it was happening. Now everyone knows that it's happening, and it looks horrible when there's a hack or an exploit or something like that. But that doesn't make the system bad. That's what experimentation is. And that's why, if we go back to the question of why do we go from Bitcoin to ETH to all these other chains, is because we have to have that experimentation. We have to have some place to do that. And the difference with crypto is we're experimenting in real time with real money all the time. This isn't like we're going to test something out and only those investors are going to be the ones that are at risk. It's, we're going to test something out. People are going to pour their crypto into this protocol or into this smart contract. And man, we hope it works. We hope there's not some bit of code in there that can be exploited, because if there is, it's gone, right? So it's magnified a lot more. But that doesn't make it bad. That makes it actually progressing much faster than any other technology we've ever seen.
Yeah, I think you're right about the point of innovation and advancement. I mean, one of the things that's crazy about the open source nature of blockchain is that you can literally take an existing decentralized finance service and make it better. Like, so I was referencing Morpho a little bit earlier. Morpho, right? It's built on top of another DeFi protocol. Right? You can't see that. You don't see that in normal banking. You don't see that level of innovation. You don't see every year or two a new type of way to do banking. Okay, this one's a little bit more capital efficient. Okay, now we're not only introducing a USD stablecoin, now we're introducing a euro-based stablecoin, right? There's all these different innovations that are taking place. I think it's very exciting. I think it's interesting. I think there's also an incentive to make a better product, right? If you can earn 3% instead of 2.5% and take on the same smart contract risk, but using a little bit more math and a little bit more statistics, people are going to do that. And then people are going to build even more on top of that. And as I just mentioned, through a very simple example, Morpho is doing that exactly.
Exactly. And you mentioned, like, we haven't had that in the traditional world, right? Where, like, banks don't build on other banks, right? They don't build their application on top of another on top of another bank's application, right? They're kind of, they kind of work together because they have a system where they can send money back and forth, and then they're kind of in competition with each other, right? We don't have the stacking that we see in the blockchain world.
So, final question for today's podcast. Are there any interesting pieces of the puzzle, blockchain and crypto, that you think a person just learning about the space should know? Is there a 1 or 2 sentence line? Is there a small piece of advice that you would give to someone who said, oh, maybe I'm interested in learning Solidity for the first time. I already know how to code in Java. Maybe it's someone who's already exposed to the finance space and they might want to learn a little bit about DeFi or learn a little bit about real world assets. What 1 or 2 sentence piece of information or advice would you give them?
So that's a good question. And I can't speak as much to the tech side. I'm not a programmer. I don't know Solidity or Java or anything like that. So I can't tell you what you need to learn there because I don't know how to program anything. The last thing I programmed was probably BASIC when I was, probably 10 years old. So if I can speak to the kind of financial piece, is at this point, I think it is actually important to go all the way back to the basics and start learning about, one, why Bitcoin even exists, why Bitcoin started. And this might be really boring to put on a podcast because it's not the cool, fun thing to learn. But if you learn why it exists, that gets you back to the kind of issues that gets you back to how the traditional financial system works, which lets you work through why Bitcoin exists and why we feel we need it, why it was successful, why Ethereum exists, why decentralized finance exists, what lending protocols are and such, how they kind of equate or not equate to what banks do. And it allows you to look at decentralized finance, especially, and potentially real world assets, not as this speculative crypto asset, but as this necessary evolution and innovation that's just going to happen, right? I think that to me is the most important part. If you understand where we came from, you understand what these systems are trying to do to make that more efficient. And again, that doesn't mean speculation. That means just greater efficiency on the current financial system using the technology we have. If you wanted me to go into one area that I'm actually excited about, this is probably the most boring area to be excited about, but it is decentralized insurance. Without a doubt, I think it is decentralized insurance. I think is in the insurance industry is so badly in need of innovation and hasn't had it in so long. And I think the idea of decentralization is going to give it that shot that it really needs. And we've already started to see it with the likes of Nexus Mutual and what they've done recently with actually going off-chain with insurance, taking their on-chain pools and going off-chain. I think that's tremendously exciting. And then what you can do with those pools in terms of holding, tokenized treasuries or something, I think is going to be tremendously exciting with what's going to happen in insurance in the future. So if you want me to give the most boring industry that I think can be upset and really take advantage of blockchain technology, I'm going to go with insurance on that.
Okay. I like the choice. I'm excited to keep an eye out in the headlines for blockchain decentralized insurance in the next year or two. Let's see if it comes to fruition. Yeah. So with that said, Adam, it was a pleasure to have you join me on the podcast today. I learned a whole lot about finance, a lot of stuff I didn't know going into this podcast. So thanks for joining me here.
Thanks for having me, Ari. I really appreciate it. An honor to be here.
Thank you for listening to this episode of the Ari Kim podcast. Please consider supporting it through the Make a Contribution button or the wallet address found in the video's description.